Hello everyone, this is Jordan and this is your precious metals market update. Today is Monday, July 27th, 2015. And this chart shows all of the bear markets in the gold stocks, and the index we use is the Barron's Gold Mining Index. The last data point, which came out last Thursday, it comes out weekly, that showed this bear market being down about 79%. Which is just about the worst. Well, I shouldn't say just about. It is the worst ever. And also, if you look at GDM, which is the same thing as GDX, that is its worst ever bear market. It surpassed the 96 to 2000 bear. The XAU has done that as well. And the Huey Gold Bugs Index would have to go below 100 for the current bear market to be the worst ever. I believe it closed at 107 today. So that's very, very close. So essentially, we're now looking at the worst bear market ever. And on this chart, we plot the 10 and 50 week rate of change in the Barron's Gold Mining Index. And we also plot the distance the index is from its 10 and 50 week exponential moving averages. So we're kind of looking at a near-term view and then a yearly view of how oversold the market is. And essentially, from where we are now, there are 6 other oversold points that are equal to how oversold the index is right now or more oversold based on what we're looking at here in this chart. And if you look at those instances, 4 of those 6 were major important bottoms. You had 2008, you had 1982, which had a huge, it was a 200% rally after that in something like 7 months. And these are the absolute biggest stocks. So a 200% rally in this index is an even greater rally in the Huey or GDXJ. And also you had 1976, 1969 or early 1970 there. So the only 2 that did not produce those huge cyclical uptrends were in 1998 and in 1941, and of course the market would bottom after that. But I liken those 2 instances to where we were in 2013 when we became extremely oversold in the gold stocks, but it wasn't the end of the entire bear market. So where we are right now, I don't see any, I see it being very similar to those 4 that produced the huge cyclical uptrends and not those other 2. Now moving on, this is a daily candle chart of gold, and we can see on Friday it made a huge reversal on fairly large volume. Today it traded over 1100 but couldn't get above it, so that's very short-term resistance, 1100. If we close above 1100, we should be on our way to 1130 and 1140. And retesting that breakdown that occurred below 1140 to 1150. But back to this potential low, we can see that there was very big volume, as I said, but also the RSI indicator there at the top was extremely oversold. So this daily look here, it shows that there's good potential for gold to have a little rally here back to, I'd say probably 1140, and then at that point, you'd probably see some selling. And keeping on the same theme, this is a weekly chart, and we plot the net speculative position in the COT. As you guys know, we plot that as a percentage of open interest. It gives us a consistent reading that we can compare to 10, 20 years ago, as the nominal positions are always changing. And at the top, what we see, as we said, gold, clear breakdown below 1140 to 1150. As of now, it's holding 1080, and there's that major support around 1000. So if gold does bounce back up to the breakdown point, that would be a short-term sell, because it's possible it could bounce back to 1140, and then it would decline towards 1000. That would be the final move down and likely the end of the bear market. Now, the other scenario is if we don't hold 1080 or we break below that this week. I mean, there is a scenario and the possibility that we break that support this week and then we just get a major sell-off that goes down to 1,000. And in that case, we could have the bottom in the next couple weeks, the bottom being the end of the bear market. I don't see that. I think it's more likely we're going to rally up to resistance, then sell off, then make a bottom or the end of the bear market after that, maybe a month and a half or 2 months from now, something like that. But let's get back to this chart and go to the bottom where we can see the COT. Now, the last reading was a net position in gold of 4.7%. That did not go lower than the 4.4% in June 2013. So basically where we are right now, we're at the second lowest position since the end of 2001. So the second lowest position in 14 years. So that's very bullish, but it doesn't mean we're at the end of the bear market. We absolutely have to bottom right here. I mean, this reading, it can get even closer to zero in the next couple weeks or the next month or two. And we could even see speculators being net short, which they haven't been since the very end of 2001. Now, last thing here I want to talk about is the stock market, because with the way things have been setting up over the last couple years, there's this negative correlation. And so if we see problems in the stock market, that's going to be very good for gold. Technically, because the two have been trading in opposite directions for about 4 years, but also on the fundamental side, because if we see problems in the stock market, that is going to induce a lot of new policy from the Fed that's going to be favorable for gold. Maybe they only do one rate hike. Maybe they don't hike and they decide they're going to maybe even cut rates or do another QE. So it's kind of the reversal from the belief that, the Fed is going to hike rates, they're going to do a couple rate hikes. It's a reversal from that to, well, now we have to support the market somehow. So that is what would be bullish for gold and precious metals. And here we have a chart of the NYSE, which has a lot more stocks than the S&P. It has about 2,000 stocks, and therefore it's weaker than the S&P. And what we see at the top, we're showing the percentage of stocks that's above the 200-day moving average. It's only 37% right now. It's badly diverging. Then the next column, it shows the number of new 52-week lows. It looks like right now we're about at the highest point since 2011. So that's another warning sign. And then the next indicator is the 5-day moving average of new highs minus new lows. That is also showing a negative divergence. So that right now is at its second lowest level since probably the end of 2012. So these breadth indicators are flashing red. They're flashing danger. And if you look at the chart itself, this is just a weekly price plot. We show the 80-week moving average. Again, use the 80-week or the 400-day moving average on your charts. I think they tell you a better story than the 200-day or 50-week, 40-week moving average. That's just my opinion. But we can see the 80-week moving average has clearly defined the trend over the last 10 years. We have some arrows there which mark key turning points, and we can see, zooming in on the last year, the market has been barely holding the 80-week moving average. Now it's moved below it. That doesn't mean we're going to necessarily crash right away, but it really does mean that we could be starting a new bear market. And looking at this chart, there's a clear pivot point, which looks to be about 8,500. That's also the 38% retracement of the entire bull market. So that would be, I think it's about a 25%, I don't know, it could be a little more, a little less, but I think that's the downside potential, over the next 6 to 12 months or 6 to 18 months. So it's hard to know how it'll play out. I mean, some bear markets like 1987, they happen very quickly. Some are slow and drawn out. But in any event, the way things are setting up right now in U.S. equities, it's going to be bullish for precious metals. Not necessarily immediately, but I think over the next couple months. It definitely will be, and we're going to see the end of this bear market, I think, in the next couple months for precious metals. So that's all we have for today. Thank you so much for listening and watching. You can follow my work at thedailygold.com. You can sign up for my free newsletter there. And if you have any feedback, feel free to send it to me, Jordan at thedailygold.com. Again, thank you for listening and watching, and I wish you all the best.